It's time to go back to the playground because today we're calling the Reserve Bank liar, liar, pants on fire. And we're not the only ones. So what's the deal? Well, the Reserve Bank is telling us that they're going to keep the official cash rate on hold until at least 2024, or until it meets its inflation and growth targets, which is great news for home buyers if you take them on their word. But are they being 100% honest with us? Can they really be trusted? We have our doubts, and we're not the only ones. A few days ago, ANZ released their Australian Economic Insights report. And in that report, ANZ's economic team is predicting that the RBA could increase the official cash rate as early as the first half of 2023. And you could see the cash rate rising as high as 0.5% by the end of 2023. That's big news. Interest rates haven't increased for over 10 years. In fact, the 3rd of November 2010 was the last time the RBA increased the cash rate by 0.25%. Since then, we've seen the cash rate plummet from 4.75% to 0.1%. And it's never been cheaper to borrow money than it has been in the past 12 months. But all good things come to an end. Interest rates can't stay this low forever, so they're going to go up at some point. If you believe the RBA, we've still got 3 years before we see any major movements. But according to ANZ, we've got 2 years or even less. When interest rates go up, what's going to happen? Or once interest rates go up, are they set to rise? If they do, what does this mean for you? Will you still be able to afford a mortgage in 5 years' time? The big question here is the era of cheap money coming to an end? My parents love telling me war stories when interest rates used to be 10+% when they bought their first home. It's worth remembering that since 1990, the official cash rate has dropped 48 times. In April 1990, the cash rate was 15.5%. In early 2020, it's just 0.1%. So now I wonder if I'll be doing the same with my kids when they grow up. I remember when interest rates were 1.79% back in my day. With all this uncertainty around interest rates, you're probably wondering whether you should fix in now. Get in while the getting is good, as they say, and that's what I'm going to cover today. We're going to cover the ins and outs of fixing in your loan, the good, the bad, and the ugly. Let's start off with the good. Fixing in your loan has the potential to save you thousands of dollars if you lock in at a low rate before interest rates go up. A fixed rate loan provides you with security and stability. For the duration of that fixed loan, you know exactly how much you need to pay each month. And if that variable rate starts to creep up, well, you won't be affected at all. Let's look at a quick example. Let's say that you've got a loan of $500,000. If you were to fix it in right now for 2 years, you'd be able to get a rate of around 1.89%. So let's say for 2 years, you're going to be paying $1,821 per month in mortgage repayments. It doesn't matter if rates go up, down, side to side, whatever happens, you're locked in at that rate and that repayment over the next 2 years. Compare that to a variable rate of the same amount. The average current rate is 2.5%. So repayments today on a $500,000 loan would be $1,976 per month. What happens, as the ANZ predicts, if the cash rate goes up by 0.5% by the end of 2023? Now, the banks don't always match the Reserve Bank when they change the cash rate, but in general, if the rate goes up by 0.5%, you'd expect your variable rate to now be 3%. So your repayments would increase to $2,108 per month, or $132 higher per month. As you can see in this scenario, you're much better off fixing in your loan. But now let's look at the bad side of fixing in your loan. The biggest downside to a fixed rate is your flexibility. Think of a variable loan like an Olympic gymnastic. They're super flexible. A fixed rate loan is more like a middle-aged man whose idea of stretching is when the remote control falls down and they're trying to reach down off the couch to pick it up without getting off their chair. In other words, they're not flexible at all. Here are the main downsides of fixing in your loan. Number one, you only have a limited ability to make extra payments. There's usually a limit of around $10,000 on extra payments before penalties apply. So if you're getting a new job, a big bonus, or a lump sum of cash, you might not be able to use that to pay off your loan. Number 2 is that you have limited facilities. Depending on the lender you're with, you might not be able to link an offset account to the mortgage, and if you make extra payments, you may not be able to redraw those out if you need to access those funds in the future. It's worth a mention that there are some lenders that still allow you to retain the full flexibility with a fixed rate, but in general, you have fewer options when you fix versus a variable rate. Now let's talk about the ugly of fixing in your loan. Break fees. If you want to make an extra larger payment in your loan, switch to a variable rate, or sell your home and close a loan account completely, then the bank's gonna charge you the privilege for this. Basically, the banks let you fix in your loan because of the stability and security goes both ways. You know how much you're gonna be paying each month, and so does the bank. They can rely on your payment when projecting their monthly revenue and cash flow. So if you disrupt this by switching from a fixed to a variable or selling your loan and closing the loan, they're gonna charge you for it. These break fees can range from a few $100s to thousands of dollars. So if you're thinking of fixing in your loan, you wanna make sure that you like the bank you're with and you're not gonna be doing anything major like selling your home or refinancing to fund a renovation. But there is a way you can have your cake and eat it too. If you split your loan into 2 loan accounts and fix one of those loan accounts, you can have the best of both worlds. A variable loan gives you the flexibility to make additional repayments, have an offset account, and redraw facility too. While a fixed rate loan gives you the stability and, at least for the moment, a better rate. Lastly, we've been doing a lot of split loans for our customers for that exact reason. Now we've covered the basics of fixed loans, let's dive into some further details. Firstly, how do you fix in your loan? It's a pretty simple process. If you've already got your home loan, most lenders can fix in your rate over the phone. But don't go dialing your current lender just yet. Give us a call on 1300-088-065 or hit us up on our contact form at huntergalloway.com.au. We'll be able to review your situation and your financial goals to make sure that you're making the right decision. In many cases, we're able to get a better rate than going to your lender directly. Next, how much should you fix? As mentioned earlier, fixing your entire loan does limit your options in terms of extra repayments and other facilities, which is why we typically recommend going for a split loan between fixed and variable. To figure out how much to fix and how much to go variable, try to make an educated guess as to how much you're likely to pay off your loan during the fixed period and keep that proportion variable. You'll be able to make extra repayments on the variable portion without incurring any penalties or nasty break fees. Finally, how long should you fix for? The length you choose to fix in depends on 2 things. Firstly, what you believe the future of interest rates will be. If you think rates are going to go up in the near term, like the analysts at ANZ believe, then fixing in for a longer period of time might be better. If you think they're going to go down, which is very unlikely in the current market conditions, then fixing for a shorter period might be a better option. The second thing you need to consider is your short-term goals for the property. If you're thinking of refinancing your loan, making larger repayments, or even selling the property within the next few years, you want to make sure that you choose a fixed rate term within that short period of time. If you're not sure how long to fix, we're happy to review your situation and give you some advice. Just give us a call or contact us on our website and we'll give you some advice, no problems. Even though we're not expecting any major movements in the cash rate from the Reserve Bank in the next year or two, that's not the only thing that affects your fixed rate. Most of the big banks have actually increased their fixed rates recently. This is mainly because the government has stopped lending them cash at super cheap rates. But as time goes on, it's likely that the fixed rate will continue to creep up. The banks keep a close eye on economic conditions and will adjust their fixed rate to make sure that they don't miss out on any revenue by keeping their rates too low. And if you're setting up a new loan or refinancing to another lender, you're not necessarily guaranteed the rate that you think you're getting at application stage. If the interest rate goes up between your application and settlement, then you'll get the interest rate on the settlement date. If you're worried about this, there is something you can do called rate lock. A rate lock is a guarantee that you'll get the current interest rate from 60 to 90 days at the time you apply for your loan. So if interest rates go up, you'll get the lower rate. Some lenders will also give you the lower rate if interest rates fall. There is a once-off fee. It ranges from lender to lender. It's about 0.15% of the loan amount to lock in your rate. It'll give you some peace of mind and assurance whilst your loan is going through the application process. So that's it for today's video, guys. I hope this has helped shed some light on the pros and cons of fixed rate loans and give you a heads up of where interest rates may be going. If you're thinking of fixing your loan, make sure you give us a call first. Visit us online at huntergalloway.com.au or call on 1300 088 065. We'll be able to review your financial situation and goals and help make sure you're making the right decision. We'll see you next time.